Society drills a single narrative into your head from birth: stay out of debt, pay off your house, and save your cash. But everything you've been taught about debt is a mathematical trap designed to keep you poor. Retail investors are trained to view a zero balance as the ultimate finish line. Meanwhile, the top 1% use leverage as an architectural tool to borrow capital, acquire appreciating assets, and legally bypass the tax code. For the working class, that deep fear of debt is mathematically justified. Consumer debt destroys retail wealth. High-interest credit cards and auto loans are financial sinkholes that pull money directly out of your net worth. This is toxic retail leverage. You secure fast access to unsecured capital to upgrade your lifestyle beyond your active income. You buy luxury clothes, a depreciating vehicle, or a vacation. The asset loses its value the exact moment the transaction clears. You are left paying interest on a phantom asset. The wealthiest operators on Earth approach this completely differently. They understand that money is a neutral unit of measurement, which means debt is simply a lever used to move massive objects. Look at this visualization showing the core mechanic of institutional leverage. You borrow capital at a flat, fixed cost, and use it to acquire an asset that generates a yield, represented by this rapidly rising vertical bar, that completely outpaces the debt obligation. Apply this to real estate. An institutional investor uses debt to acquire a property, stabilizes the rent, and forces the valuation up. But instead of selling it, they execute a cash-out refinance. They pull their original equity back out completely tax-free, because the IRS treats extracted debt as a loan, not taxable income. They deploy bet-extracted capital to acquire property number 2. The tenants pay the debt service on both buildings, and inflation continuously erodes the true cost of the mortgage. They scale an empire using the BIN's liquidity, but physical real estate has friction. It requires time, contractors, and market timing. Operators looking for higher velocity returns transition to human capital arbitrage. They use debt to acquire asymmetric skills. Borrowing $100,000 for a degree in a low-demand field is financial suicide. But if you borrow $50,000 to master data architecture, and that specialized skill raises your baseline income by $100,000 annually, you have engineered a permanent compounding spread. The initial debt is temporary, but the baseline income increase is permanent. Acquiring specialized institutional-grade knowledge transforms fixed debt into a high ROI asset. Once you build serious cash flow through high-leverage skills, you face a scaling limit. You cannot work more hours. This forces a transition into corporate leverage, using business loans to separate your personal liability from your operational risk. You establish an LLC and borrow commercial capital to acquire inventory or hire operators. The business generates revenue, pays down the debt, and scales. If the venture fails, the corporate veil protects your personal assets. If it succeeds, you own an automated cash-flowing system built entirely with external capital. The apex level of the structure is institutional investment arbitrage. This strategy involves borrowing capital at a near-zero interest rate and injecting it directly into an asset class that dramatically outpaces the cost of the debt. Look at the macroeconomic strategy executed by MicroStrategy and its founder, Michael Saylor. They engineered a debt matrix to exploit this exact mechanical glitch. They issued billions in 0% convertible bonds and borrowed massive amounts of fiat currency at rock-bottom fixed rates. Then, they immediately converted that cheap fiat into a hard, decentralized asset. They used the legacy financial system to short fiat currency against Bitcoin. The cost of their debt is negligible compared to the compounding growth of the underlying asset. They used other people's depreciating fiat to capture appreciating scarcity, ultimately building a massive multi-billion-dollar capital moat. Acquiring these assets is only half the equation. If an investor simply sells their assets to realize the gain, they trigger a taxable event. The government will step in and extract up to 40% of that wealth. Retail investors fund their lives through active salary, which is taxed at the highest marginal rate. The ultra-wealthy avoid this entirely. They do not take salaries. They take on debt. This is the buy, borrow, die framework. When institutional founders need liquidity, they go to a Tier 1 bank and pledge their massive stock portfolios as collateral to extract a securities-backed line of credit. Because they are extracting cash through a loan, the IRS does not classify it as income. It is completely tax-free. They pay a marginal interest rate of around 3 or 4%, while their underlying assets compound at 8 to 12%.
The asset growth naturally outpaces the interest expense, allowing them to fund luxury lifestyles entirely tax-free. When they die, the assets receive a step up in basis. This completely wipes out the capital gains for the next generation. The debt is settled against the estate, and the generational wealth transfers perfectly intact. Debt is a mathematical filter. It destroys those who lack discipline and enriches those who master leverage. If you refuse to build these structures, you are choosing to be the liquidity the wealthy use to get richer. Stop playing the retail game. Subscribe to the Money Formula. Hit the notification bell. Get structured or get liquidated. The choice is yours.